I was just saying we have developed guidelines on a very interesting product, which is the exchange traded funds. And we have Bruce instead to walk us through the guidelines and also explain to us the opportunities and the benefits to the issuers of these funds and also to the investors. Bruce, you're welcome, and I pass on the mic to you to take us through the presentations and the discussions for today. Thank you.
Thank you, Dingasi, for that introduction. And good afternoon, everyone on this call. I'll skip the introductions. I think Dingasi has done that. I'll go straight into the presentation. So this afternoon, I'll basically take you through the exchange traded funds. As Dingasi mentioned, the Commission has come up with guidelines for the issuance of exchange traded funds. And if you look at the capital markets master plan that was approved by Cabinet last month, one of the things highlighted in that master plan is that we in our market we lack diversity in terms of the product range. So there's some proposals in the capital markets plan in terms of what products can be introduced to our market to increase that diversity of product. And one of these products is the exchange traded funds. So basically, in terms of the outline of my introduction of the presentation, I'll have an introduction to exchange traded funds so that we understand what they are. And that will help us really to understand the silent features of the SEC guidelines on exchange traded funds. Then I'll lastly speak to the benefits of investing in exchange traded funds. So that's the outline of my presentation this afternoon. So what is an exchange traded fund? Basically, an exchange traded fund simply is a collective investment scheme with the following characteristics. Unlike it's traded on an exchange, unlike a traditional fund where you buy and sell units from the manager. An ETF is traded on an exchange. Therefore, you buy and sell your units, the ETF units, through a stockbroker, just as you buy and sell ordinary shares. Therefore, you cannot buy ETF units directly from an issuer. The other characteristic of an exchange traded fund is that the ETF typically tracks an index. So the price of the ETF tracks the underlying index. However, some ETFs track specific assets, such as a currency or a commodity. So in the case where the ETF is tracking an index, the underlying index can be a broad market index, such as the Luce All Share Index, which comprises of all the 32 listed companies on the Lusaka Securities Exchange, or it can be a foreign index. For example, the Standard & Poor's 500 index in the US, or the FTSE 100 in Britain. Or the index can, instead of tracking a broad-based index, the ETF can track a sector index. For example, we have 3 banks that are listed on the LUSE under the banking sector. An index can be constructed to track the performance of those 3 banks that are listed on the exchange. Therefore, the index will be tracking a sector as opposed to tracking a broad index. An example that I can give with respect to a commodity ETF is New Gold. New Gold is an ETF that is issued by Absa Capital. This ETF basically tracks the price of gold on the London Metal Exchange. So they buy gold bullions, which are stored in a vault, and the index start tracking the price of gold on the London Metal Exchange. So for example, New Gold has been listed on several African countries. It's listed in Botswana, Kenya. There's also Nigeria, Ghana, and Mauritius. An ETF is open-ended, which means that the number of units in the fund is not fixed. The ETF issuer can create or buy back or redeem the units in response to demand from investors. So, for example, if the existing supply is insufficient to meet the investors' demand, the authorized participant, who's a market intermediary, can redeem the units, can apply to the issuer for new units to be created, and then sell those units on the exchange. On the flip side, if the supply of ETF is more than needed to meet demand, then the authorized participant can redeem the units, hence reducing the number of units in issue. Therefore, the open-ended structure of the ETFs helps to ensure that the market price stays at, or it's very close to, the NAV. The ETF also trades at NAV, that's the net asset value. So the price of an ETF should be at or very close to the NAV. The NAV is basically reflects the market value of the underlying portfolio, which is adjusted for fees and expenses and expressed as a unit. So it's very important that when one is considering buying ETFs, you check for possible tracking errors which can occur between the price of the ETF and the NAV. I'll explain more in details in terms of the relationship between the ETF price and the NAV later in my presentation. So, how are these exchange traded funds created? You can only buy ETFs on the secondary market, a market like LUCE. Unlike shares where you can buy shares in a float during a public offer, ETFs can only be purchased in the primary market in a float by authorized participants. So these are authorized participants are basically financial intermediaries who sign a contract with the ETF issuer to be able to create and redeem units. Therefore, the issuer of the ETF only deals with the authorized participants and not the investors. So in terms of the creation of the units, what will happen is that the authorized participant who apply for units in the ETF. So if the ETF is tracking an index, what the authorized participant would do is he will purchase securities in the market comprising the index and deliver that basket of units equal to the ETF value to the issuer. So in return, what the ETF issuer will do is he will now issue the ETF units to the market, to the authorized participant, who will then go into the market and sell them to investors. So what happens to the underlying securities that the authorized participant delivers to the ETF issuer? When the ETF creates the unit, the underlying assets, then the underlying securities delivered by the authorized participants are transferred to a custodian who is responsible for holding them. So he keeps those securities in custody. In terms of redemption, the redemption process works in the opposite direction to the creation process. The authorized participant will apply to the issuer to redeem the ETFs. So what the authorized participant would do is transfer the ETFs to the issuer. So they'll buy them in the market, then transfer the ETFs to the issuer, which in turn delivers a basket of the underlying securities to the authorized participant. Then once the ETFs have been delivered to the issuer, then the issuer will basically cancel the ETFs. So that's how redemption of ETFs are done. So the next slide speaks to understanding the net asset value. It's important to understand that the market price and the net asset value are two different things. So the market price basically is the price at which the ETF is trading on the exchange, while the NAV is the total value of the assets in the ETF adjusted for fees and expenses and divided by the number of units So that will give you the net asset value per unit. So, so it's very important that the market price of the ETF should be very close to the NAV. Otherwise, if the market price of the ETF and the NAV are not in line, there's an opportunity for arbitrage by the authorized participant. So what keeps the market price in line with the NAV? The price of an ETF should rarely deviate from the NAV. So if the price of the ETF moves out of line with the NAV, then an arbitrage opportunity will exist for the authorized participant. Let's assume that the price of the ETF is lower than the NAV. And this could be because demand has dropped relative to supply. So the price is lower than the NAV. So what the authorized participant will do is he'll buy the ETFs on the exchange, then deliver them to the issuer in exchange for the underlying securities. Then the authorized participant will sell those securities on the exchange. So by doing that, the difference between the price paid for the ETFs and the amount received for selling the securities on the exchange will be the profit. So that's how the authorized participant will make a profit from the mismatch in terms of the price of the ETF and its net asset value. So by buying the ETF will now push the price of the ETF until it aligns itself with the NAV. So if the situation is the other round where the ETF price is higher than the NAV, what the authorized participant will do is they'll buy the underlying securities on the market, on the exchange, deliver them to the issuer in exchange for the new ETFs, then sell the securities, then sell the ETFs on the exchange. So by doing that, the difference between the price they paid for the securities and the amount they've received by selling the ETFs on the market will be the profit. So the selling pressure will push down the price of the ETF until it aligns with the NAV. So the tracking of the NAV is a fundamental characteristic of ETFs. I'll move to the second part of my presentation, where I'll walk through the silent features of the guidelines that we've, the silent feature of the draft guidelines that the Commission has come up with. So the guidelines are basically to help promote the issuance of the exchange traded funds on the market. I won't go through all the guidelines, but I just selected the ones which which are very important, which the public needs to be aware of, especially the market players and the potential issuers. So when you look at the draft guidelines, under guideline number 2 is where we have the application of the ETF guidelines. How are they applied? The guidelines apply to physically backed ETFs. Broadly speaking, ETFs can be categorized as either physically backed or synthetic. Physically backed ETFs hold the physical assets that the ETF is designed to track, whereas synthetic ETFs use a derivative, basically swap, to achieve its investment goal. So these guidelines apply to physically backed ETFs and not synthetic ETFs. So that's the application. In terms, guideline number 4 looks at the authorization. Remember, the ETF is basically a collective investment scheme with certain characteristics. So it has to be approved before it's issued, before investors can start investing in the ETF. So an issuer of an ETF must obtain authorization from the Commission by applying for that authorization pursuant to Section 121, which requires collective investment schemes to be approved by the Commission. So the only difference is that there's this, if you look at the guidelines, there's a clause that specifically requires that when the application is made to the Commission, the name of the ETF should, whatever name is given to the ETF, it should end with ETF, so that we're able to distinguish it from the traditional collective investment schemes. In guidelines 6, 7, 8, 9, 10, 11, and 12, this deals with the ETF ecosystem. There are various players in the ETF ecosystem who play various roles. These include the ETF issuer, the market makers, the authorized participants. So there are several players in that ecosystem with different responsibilities. For example, an authorized participant should be a licensed dealer, and an ETF should have at least 2 authorized participants, of which one of them should be a market maker. The other participants or the other players in this ecosystem, you find index provider, where the ETF is tracking an index. The ETF needs to appoint an index provider, and this index provider can either be an exchange or a recognized local or foreign company with some experience in providing an index. So that part basically talks about the different players that needs to be appointed, and in order for the ETF to function properly. In guideline 14, which looks at the creation of units in exchange for cash. In most instances, ETFs are either created or redeemed in kind. Therefore, the authorized participant delivers a basket of securities. Then in exchange, the ETF issuer will issue the ETFs or vice versa. So it's that process, the creation and redemption of ETFs. That entire process is called referred to as in kind or in specie. So guideline 14 covers the creation of these units in exchange for cash. So you saw the law allows for the authorized participant to give cash instead of securities. So therefore, it's not the creation or redemption. The creation is not done in kind. However, in a situation where the creation is not done in kind, there's cash which is given. The ETF has a responsibility to purchase the underlying securities to represent the securities in the index within a prescribed period. And this is only allowed where the process would not prejudicial the interest of the unit holders, and if it's permitted in the constitutive document of the ETF, and the Commission has the right to allow or disallow this option if the Commission is of view that it's not in public interest. In guideline 15, which covers the direct redemption of units, remember the redemption of units is done by the authorized participant. An investor cannot go directly to the issuer and redeem the units. However, in guideline 15, there is an exception where the investor can redeem the units directly from the ETF, subject to the approval of the Commission. Now, there are instances where this will be allowed. And these include if the ETF is delisted on the exchange, or the trading in the secondary market has been disrupted for a longer period of time, or when the market price of the ETF significantly varies to its net asset value. So in those circumstances, redemption may be allowed directly from the issuer of the ETF. Guideline number 18 looks at the investment restriction. So the weightage of the component securities of the ETF should be the entire component of securities of the benchmark index, except where the ETF is unable to fully replicate the benchmark due to market conditions. Therefore, in such cases, in the guidelines, there's the deviation that will be allowed is up to 10% And this should be provided for in the constitutive document of the ETF. So in other words, we're saying the Commission may allow partial replication in the index, depending on the market conditions. Sometimes, because sometimes you may not be able to achieve a full replication of an index because of market conditions. For example, if you are dealing with an illiquid market. So I thought these are some of the clauses that I thought would be of interest, especially to the issuers and market players. So these guidelines will be distributed to the potential issuers and market operators so that they can make comments on the proposed ETF guidelines. So my last part of the presentation looks at the benefits of investing in exchange traded funds. ETFs enable investors to gain broader exposure. So you get exposure to the entire market if you buy, because if you're buying an ETF that tracks a broad market index, it gives you exposure to the entire market. It also gives you exposure to specific sectors of the market. If you remember the example I gave about the 3 listed banks on the LUCE, if your interest is in banking, you can buy an index tracking the banking stocks, can be constructed, and it tracks that particular index sector. ETFs also allows you to invest in different asset classes. For example, if I want to get exposure to gold, I can buy an ETF that tracks the price of gold, like the example I gave of new gold, which tracks the price of gold. Or it can be any other commodity. It can be oil, it can be wheat, but it gives you exposure to different asset classes. ETFs are also fast and efficient in the sense that because they are traded on the exchange, it's real-time access to markets. They are liquid. They're liquid in the sense that every ETF must have a market maker. This market maker will have the role of buying and selling ETFs. Therefore, it makes the ETFs to be very liquid. They are convenient in the sense that a single purchase gives exposure to the whole entire market or a market segment. They are transparent. The fact that ETFs are listed comes with transparency. Usual ETF prices are published on the issuer's website and on the exchange. And the other information that will be published about the ETF will be things like the funds are holding. And these publications will be done on a daily basis. So in that sense, makes ETFs to be transparent. They are cost effective. in the sense that if I buy 1 unit of an ETF, for example, if we had a loose ETF that tracks the all-share index, by just buying 1 unit of an ETF, I'm buying into 23 companies. And if I compare that, if I had to buy shares, 1 share in each and every 23 listed companies on the LUCE, that would be expensive. So in that sense, they're quite cost effective. So this brings me to the end of my presentation. Thank you so much for your time. Over to you, Ndingazi.
Yeah, thank you very much, Bruce, for that very enlightening presentation. I think it's exciting that we are moving towards more products in the market. And I do hope that the potential issuers and also potential investors have really appreciated this presentation, which is specifically brought to them even before we start with the ETFs. At this point, I'd like to invite questions for Bruce. Any clarification or even contributions would be good. I'll start with what is in our chat, in our question and answer session, and I would like to encourage everyone to do the same, to post the questions or even raise your hand if you wish to make your contribution. I'll just go ahead and read the questions. We have a question from Nicholas Kawaso, who says, why are the guidelines taken in a specific view on physical backed ETF and not synthetic? Is it local market demand driven? That's a question for you, Bruce, there.
The reason why we've taken this view is that the largest group of investors in our market are pension funds. And pension funds do not usually invest in derivatives. So for us to attract the pension funds into the capital markets, in particular into ETFs, we had to design the guidelines the way we have. Furthermore, we also did some research within the region when we're coming up with these guidelines. We also noticed that or observed that, for example, if you look at South Africa, even South Africa, the concentration is on the physically backed ETFs as opposed to synthetic ETFs. Because with their synthetic ETFs, they're bringing a lot of risks, because the ETF will enter into a contract with a counterparty, and so in that contract, the ETF may be paid, or it may pay the counterparty. So there's that risk that is involved, depending on the performance of the ETF. If the ETF does not outperform the index, there may be some money paid. So in that context, it brings in a lot of risks. So that's the main reason why the focus was on physically backed ETFs, because these are backed by assets. I hope that answers Nicholas' question.
I hope, Nicholas, you are fine. And if you do have a follow-up, please feel free to do so. We have Emmanuel Banda who says, thank you. You mentioned the benefits. What are some of the disadvantages? Bruce, you didn't mention any disadvantages there.
One of the disadvantages I can think of is the tracking error, because you could have a tracking error where the price of the ETF and the NAV are mismatched. So it's imperative that any person or any investor thinking of buying an ETF, you first check the NAV of the ETF against the price. So tracking errors can be common, and then they can occur. But what happens in other jurisdictions is they try to put a control on the tracking errors. For example, they may say that the tracking error should not go more than 4%. So if any ETF has a tracking error of more than 4%, then the ETF is required to explain to the regulator why they've got such a huge tracking error. Of course, some of the reasons that may cause that tracking error is because you may not have, for example, you don't have full replication of the assets that the ETF is supposed to follow. And sometimes it could be just be supply and demand, but supply and demand is easily dealt with by the authorized participants by taking advantage of the mispricing. The ETF will either buy or sell the ETFs, and that will align the price of the ETF and the NAV.
Okay, thank you, Bruce, for that response, and I hope that Emmanuel, you got that. We have another question. It says, what is the difference between index fund and ETF? He seeks that clarification, the index fund and the exchange traded fund. Was that clear, Bruce?
Yes, I'll attempt to answer the question. My colleagues from SECIF and the core, they can also chip in. An index fund gets its net asset value at the end of the day, but the price of an ETF changes in real time with market conditions. So that's one difference. And of course, the other difference is the obvious reason. One is is traded on the exchange, and the other one is not. There's also an argument in terms of the cost, that the ETF is much cheaper compared to an index fund.
Which means that as an investor, one has to be watching the ETF on the exchange quite actively, isn't it?
Yeah.
Okay, we have another question, and it says, what type of ETF are you looking to launch? Maybe just to repeat what you had told us, Bruce.
Really, that's a decision of the issuers, because as a commission, we can't dictate what kind of ETF that should be issued in the market. Of course, we've given a guideline, some guidance in terms of the type of ETF that can be on the market. So it has to be an asset-backed physical. It has to be an asset-backed ETF. So it could be one that tracks an index. It could be one that tracks a commodity. But the guidance really is the type of ETF which can be issued, which is a physical backed ETF. So it's up to the market players to be innovative, because you can have a variation of ETFs on the market, depending on how innovative the market players are. One of them could, for example, one of them could be a fixed income ETF. You have an ETF that follows a fixed income index, for example.
Okay. The same person followed it up and said, is it an all-share index or a particular sector, or perhaps of certain companies? I think Bruce ably explained in your examples. So we can move to the next question. What do you think would be the motivation of ETF issuers in Zambia? And how liquid do you think the market will be in the short run?
Dingas, if you can repeat that question again.
Okay. It says, what do you think would be the motivation of ETF issuers in Zambia? And how liquid do you think the market will be in the short run?
Okay, with regards to the issuers in terms of motivation, the motivation, in my view, will be there's lack of diversity in our market in terms of products. We only have shares, bonds, and collective investments scheme. So the motivation for potential issuers is the lack of diversity. ETFs will bring some form of diversity. Also, the issuer does make a small margin in terms of managing the ETF. They collect management fees, and also fees with respect to that are charged with respect to the creation and the redemption of units. And that's what I can say for now.
Thank you, Bruce. Another question. We do have quite a few more. What's the minimum ETF can you recommend someone to buy? And he says, what's the difference between ETF and stocks? What's the minimum ETF, maybe number, I think. Can you recommend someone to buy? And what's the difference between ETF and stocks?
I can't give a recommendation in terms of the minimum number to buy, because it depends on the price at which the ETFs are trading. So I'm not really in a position to recommend any number of shares to buy. And besides, I'm not an investment advisor. But with respect to the second question, which speaks to the difference between an ETF and shares. The main difference is that an ETF basically is a fund. So you have this fund collecting monies from different investors and investing those funds. Whereas a share is you buy a stake or an equity interest in a company. The other difference really is in terms of when you pull funds together, there's that effect of compounding, which is more realized in put funds as compared to if I just buy shares on the in the company on the market.
I think this next question is similar or a rider. But before that, I recognize that you made a disclaimer, Bruce, that you're not an investment advisor. But we do have a number of investment advisors in this group. So if you have an answer, remember we have investors, those who are really, whose interest is to invest in such products, and feel free to answer to questions which Bruce cannot answer to, being a regulator. So there is another similar question which says, I only heard about how brokers can make profit on ETFs. How do investors gain from ETFs?
Okay, that's a good question. The benefit, the financial gain to the investors in ETFs are really in two folds. So if I buy an ETF that tracks, let's say the Luce-Osha index, I'll benefit from, remember these are they're traded on the exchange. So I can benefit in terms of price appreciation when the price of the ETFs goes up. Secondly, if it's an index ETF, the portfolio of securities that are exchanged and kept in custody will be earning dividends if those are if companies in that portfolio or basket of securities do well and they pay out dividends. Those dividends are paid to the ETF investors. So those are the ways you benefit as an ETF investor.
Thank you, Bruce. So you get to have all-rounded benefits as if you are trading in the stock market as well as CIS.
Yes.
Wow, that is very progressive indeed. A question from Kennedy says, when will the ETFs be available to the public?
Right now, we are trying to engage the stakeholders so that we can have their comments on the draft ETF guidelines. So once we are done with that stakeholder engagement, the guidelines will be gazetted and will be ready to go.
Okay. We also have another question which says, thank you for the enlightening presentation, Bruce. You spoke about how the authorized participants make their profit. How does the issuer make its money?
The issuer makes its money through management fees for managing the ETF. They'll charge some fees. They also make fees from each time they get a request from the authorized participant to create or to redeem units. There's a fee that's payable to them. So that's how they make their money.
A question again, it says, how many ETFs are currently being traded and which organizations are the issuers? What is the lowest and highest market price?
At the moment, we don't have any ETF listed on the exchange, but some time back, we had some interest from APSA to to have a second listing on the LUCE, but that never materialized. But for now, there's no single ETF that's listed on the exchange.
Okay. Any tentative timelines when the ETF will come onto the local market?
Hopefully, we're targeting end of December.
Okay. Lovely. Can an operator market foreign ETFs in Zambia, or can an operator track a foreign index?
Yes, that's very possible. So you can have an ETF issuer issue an ETF that tracks, for example, the S&P 500 from New York, or the FTSE 100. Yes, that's very possible. It is possible to have to track foreign indices issued here in Zambia.
Thank you. The next question is, I think the last but one, and we are getting right on to.
Just before you, sorry to interrupt.
And that's fine.
For example, the example I gave about APSA New Gold, the New Gold issued by APSA, that's a foreign ETF. It's been issued in on the JSE. It originates from South Africa, but the owners or the issuers wanted New Gold to be listed in Zambia and offered to Zambian. So that's an example of a foreign ETF that had intentions of being listed on our market.
Okay, it makes it clearer when you give that example. We have last but one question. Can ETFs include all asset classes?
I think the answer is no. That would be a recipe for a disaster. No, and the straight answer is no.
Okay. Okay, so we take it and I just wish to remind everyone that should you have questions even after this, feel free to email us or to contact the Securities and Exchange Commission. We'll be there to clarify further or even have discussions around this subject matter. The last question is not really a question, but it's asking whether we shall be sharing the presentations. And as always, yes, we will. This will be done soon after the town hall meeting. I don't have any more questions unless there's a hand that is up and I don't see any. It remains for me to say thank you very much. First of all, to Bruce, who was our presenter, and for you, the audience, who have been very interactive and kept following. It is very important for us that you give us the opportunity to explain what is going on within the commission and to clarify, because oftentimes we do have people who say they don't know much about the capital markets, but this is a way of us saying, look, we are open to the public and we would like to explain ourselves as much as possible. So thank you for coming. As I said, feel free to engage with us even after the town hall meeting. For now, it is bye from us.
Thank you.
Over to you, Sichone.
Seeing that Mwanga is on call, I will hand over the honor to him to give any closing remarks.
Yes, please.
Movanga, you have anything to say?
Hi, it's Johnny.
Yes, Mwanga, we just wanted to find out if you have any closing remarks.
Okay, yes, maybe just to add to, I think, the presentation and the subsequent comments that have been made, just to give a perspective of market development. I think as SEC, this is something that we've been trying to do for quite some time. Obviously, this is in line with promoting diversified and customer-centric products in our markets. And I think the whole idea is to explore how new and innovative products like the ETFs can help broaden the landscape for capital markets products in our subsector. And obviously, we see that as also being quite instrumental in according a greater participation in our capital markets. And also, it will be able to accord, I think, retail investors with an opportunity to have more accessible and access to diversified product portfolios, which hopefully can be done at an affordable cost. So I think we hope to have more interactions and just try and get the buy-in. And in line with also our capital markets master plan, we envisage that we will have a first ETF issued by 2027. So we do hope that the more we have this sort of engagements, that will also spur interest among the various issuers that we have, as well as help build capacity among our retail investors. Thank you, Stone, for that opportunity to say something in closing.
Okay, thank you, Mr. Condor, for those remarks. So at this point in time, seeing the time is 16:05, we hereby close the town hall meeting. If you have any other questions, feel free to email us at info@sexzambia.org.zm. With that said, we shall ensure that we send you a copy of the presentation as well as the recording. With that said, please enjoy the rest of your day and God bless.